SoFi's stock price has been underperforming compared to the broader stock market index this year. Currently, SoFi's stock has dropped to $7.07 per share after starting the year closer to $10 per share. This significant decline has left many investors wondering why the stock is falling and whether it presents a buying opportunity. In this video, I will address these concerns and provide an updated recommendation on SoFi stock. Let's dive in.
Hello everyone.
Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But before that, alert: this is not a financial advice video. As mentioned earlier, SoFi's stock price has seen a considerable decline in 2024. It has dropped from a little over $9.60 per share to its current price of $7.07 per share. This marks a roughly 30% decrease year to date, a stark contrast to the double-digit gains seen in broader market indexes. Despite this poor performance, I have consistently rated SoFi stock as a buy since at least May 13, 2024, and possibly even earlier. However, in this video, I will reassess whether SoFi stock is still a good buy given the current market conditions. To understand why SoFi's stock price is falling, we need to look at several factors. The primary reason for the decline is the rising delinquency rate for credit cards and all commercial loans, not just credit cards. The default rate has been steadily increasing and reached 3.16% in Q1 of 2024, the highest it has been since Q4 2011. Prior to this, default rates hovered around 2% to 2.5%, but they have now surpassed 3% and are continuing to rise. Additionally, consumer credit card balances have reached unprecedented levels. In Q4 2023, consumer credit card balances totaled $911 billion for large banks. This is a record high, and even when adjusted for inflation, these balances remain near historic levels. The situation is exacerbated by the unemployment rate, which, while still relatively low at around 4%, has been steadily climbing from a low of 3.4% in April 2023. The trend of rising unemployment typically continues until the economy enters a recession, as indicated by historical patterns. So why does all of this matter for SoFi? As a financial institution, SoFi has substantial amounts of debt on its balance sheet. As of now, the total fair value of loans on SoFi's balance sheet is approximately $21.95 billion, with personal loans making up the majority at $14.32 billion. These personal loans are particularly vulnerable to defaults, especially during economic downturns when people are more likely to lose their jobs and struggle to repay their debts. When individuals face financial hardship, they are more likely to default on personal loans before other types of loans, such as home loans, which are collateralized. In contrast, personal loans are typically unsecured, meaning SoFi is less likely to recoup its losses if borrowers default. Currently, SoFi reports a weighted average annual default rate of 4.8% for personal loans, higher than the overall delinquency rate of 3.16%. This discrepancy highlights the increased risk associated with SoFi's personal loan portfolio. Moreover, investors are concerned about the potential acceleration of personal loan default rates. While SoFi's student loan portfolio has a lower default rate of 0.6%, student loans represent a smaller portion of the company's lending activities. Consequently, the high exposure to personal loans poses a significant risk to SoFi's financial stability. Recognizing these risks, SoFi's management has taken steps to mitigate potential losses. At the beginning of the year, SoFi announced plans to decrease lending by 5% to 8% in response to worsening economic trends. This strategic move is reflected in the slight reduction of outstanding personal loan balances from $14.49 billion at the end of 2023 to $14.3 billion by March 31, 2024. Meanwhile, SoFi has increased its lending in the student loan segment, which carries lower default risks. Despite these challenges, SoFi continues to achieve impressive growth in terms of revenue, profits, cash flow, customer acquisition, and engagement. These positive metrics, however, have not prevented the stock price from falling. The primary reason for this disconnect is the significant exposure to high-risk lending products, which overshadows the company's otherwise strong performance indicators. It's important to note that SoFi has been prudent in its lending practices, targeting customers with high credit scores. The average credit score for SoFi's lending products is around 750, indicating a generally creditworthy customer base. However, there are concerns about the reliability of these credit scores, especially for younger borrowers with limited credit history. A 750 credit score for a 21-year-old may not provide the same level of confidence as it would for an older individual with a longer credit history. Despite acknowledging these risks, I have maintained a buy rating for SoFi stock over the past few months. This is because the potential rewards for investing in SoFi, given its growth prospects, outweigh the risks. Analysts on Wall Street predict that SoFi's earnings per share apps will grow by 51% annually over the next 5 years. Management has also expressed optimism about the company's future earnings potential. At its current valuation, with a forward price-to-earnings P ratio of 32:51, SoFi stock offers substantial growth opportunities. In summary, the risks associated with SoFi stock are indeed significant. Rising delinquency rates, high consumer credit card balances, and an increasingly stretched consumer base pose challenges. However, the potential rewards for investing in SoFi, given its strong growth metrics and prudent management, make it an attractive investment opportunity. As of June 12th, I am reiterating my buy recommendation for SoFi stock, but it is crucial for investors to remain aware of the rising risks. The risk-reward balance currently favors investment in SoFi stock, but continuous monitoring of economic trends and SoFi's performance is essential. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.